us. You're watching Investor's Guide. I'm Avni Raja. This is a show where we help you manage your money. We guide you on what best you can do as far as managing your entire investment portfolio is concerned. Joining me on the show today is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you so much for joining us. Over the last few weeks, we've gone through, the different kinds of investment avenues that people should look at, and now we are really focusing on mutual funds because that's one of the most, common ways of investing and something that even a novice to an expert investor can go ahead with. So the focus for today is planning one's mutual fund portfolio. What really should be kept in mind? How does one determine, how one should manage their entire portfolio? So, Feroze, let me start by asking you if, we can just go through the steps that one sort of needs to keep in mind, because there are some things that to look out for, including risk appetite, including your financial goals. So if we can just go through those basic points first.
Yes, Avni. I think choosing a mutual fund is a very important understanding which each investor needs to attain over a period of investing and become an expert at doing that. So I think if you have to mention a few things which a person has to keep in mind, first is understanding your risk appetite. Risk appetite is something which changes with time, changes with your situation. So understanding what risk are you inherently capable of taking, and at that moment, what does your finance allow you as a risk you can take? So assessing risk appetite is very critical. And then is when you will be able to marry that understanding with a product's risk. So I think understanding risk appetite would be the first most important thing for a person to do, because risk is the only thing which you can decide. Return of the portfolio is going to be decided by the environment, the economy. The markets will decide the return, but risk is an internal variable. So you need to understand and assess risk as the first step. The second is, after you've understood your risk appetite, it helps you formulate how much money could go into equity, how much could go into debt, how much could go into gold, real estate. If you have to look at it in a holistic perspective, not just from a mutual fund standpoint, asset allocation is what you actually get to once you have a clear understanding of what risk you're willing to take. So that's the second most important thing, arriving at the asset allocation after having understood this risk appetite. Third, now there will be different kinds of people and different situations. So choosing an advisor for yourself, if you can afford one, is the most important thing. So he helps you in step 1 and 2 as well. So I would say choosing an advisor is also a very important thing, because markets are not static. The investment environment is very dynamic. So you will need somebody to handhold you through this journey. So choosing an advisor is what I would call the third important thing. And then you start slowly building your portfolio. In the sense, you need to know what you do first. So when you build your portfolio, you will not buy the entire product basket which is relevant for you. You will start somewhere because you will not have all the money at once. So slowly starting to build your portfolio and taking that plunge into the pool to learn swimming is critical. And then monitoring your portfolio which you have so created. I think these are the 5 important things which help you achieve 80-90% of the objective of before you begin picking up the mutual fund itself.
Yes. Yes, sir. Right. So as far as, determining one's financial goals are concerned, now in the past also we've dwelt on why financial goals are important, but just to sort of rewind and revise that as far as our viewers are concerned, whether it's education, whether it's buying a house, whether it's marriage, retirement, these are all considered as financial goals, and how you choose your mutual fund, which mutual funds you pick, are all determined by these financial goals, and hence it's very important to identify those and set a timeline, because if you want to go for a holiday next year, that timeline becomes just 1 year. If you are looking for your retirement, then depending on your age, 10 years, 15 years, 20, 25 years. So those kind of timelines are very important to maintain as far as your goals are concerned, and choice of funds will be based on that. And the second part, like Feroze was pointing out, was as far as risk appetite is concerned. So you could be somebody who's more aggressive, you could be conservative, or you could simply want a balance of both. Now, once again, This is determined by your time horizon, your financial goals, and your risk appetite. So the funds you choose is a combination of all of these. And now, Feroze, I want you to weigh in here, because when one is looking to choose a fund, it depends on a combination of these factors, and that's how you go ahead and choose your fund.
Yes, like you rightly said, after you've determined your portfolio and your risk appetite, and you've chosen an advisor, and then getting your financial goals, like you rightly pointed out, financial goals are going to be a very, very important part, because everything you do, if it has an objective, if it has a goal, it becomes, the probability of achieving that becomes that much more. If you're going to have a 4-day holiday, you're not going to go to France, right? You're going to be looking at something which does not consume 2 days of travel time. So time frames also have a role to play in investing. So I think goal setting, like you've already explained, is very, very critical. Then coming to if you're aggressive, conservative, or balanced, how do you choose a fund? See, every fund actually has a certain risk and return profile. Thankfully, the regulator has created categories of mutual funds which help you cut the clutter, understand the right label of that specific fund. So please understand the different categories which are there, and make sure that you eliminate some risky categories if you're risk averse, or eliminate the very conservative if you are actually wanting to take the risk to achieve your goal. So using categorization of mutual funds as a very good indicator. And then every mutual fund in the last 2 years, I think about a couple of years back, SEBI made it a mandate to highlight the risk category each of the funds fall into. And in fact, lately, SEBI has also proposed another category of risk, which is called the very high risk category. So you will also on each mutual fund be able to ascertain on a 4-point scale, conservative, aggressive, very high risk. So seeing the risk label of each of these funds can be a good start point to marry your risk appetite, your goals, and the product in turn.
Yes, absolutely, Feroze. And finally, very quickly, the other point that you talked about, monitoring one's investments, because the asset allocation is also key as far as handling the risks and the volatility are concerned, and how you deal with all of that or monitor all of that is to, on a regular interval, not to overdo it as well, but on a regular interval, keep track of your investments.
Yes, Avni, optimal monitoring is the key word. I think monitoring it every day is meaningless. Monitoring it never till the goal is knocking on your door is also not right. So just like a pilot flies his plane, he takes off and then navigates through the journey. He doesn't just sit through it to reach the destination. There is a regular monitoring which is needed. And to my mind, the optimal frequency of a full review of one's portfolio, all his assets, is a yearly affair. And a partial review, not such an in-depth review, on a 6-monthly basis for the entire balance sheet of an individual, which has all his assets or her assets and the liabilities, is a 6-monthly affair. On a not in-depth basis, on a yearly basis, you have to make it very in-depth. I think that's the optimal frequency. And without monitoring, it's very unlikely that just a buy and hold and then wake up when the goal is there may not yield results.
Yes, absolutely. Some extremely crucial points there, Feroze, pointing out for us. But on that note, we're completely out of time on this edition. Thank you, Feroze, for joining us. But we'll be back with another episode. And on the next episode, we are specifically going to focus on, how you should choose your fund house, or how you should choose your mutual fund. What are the parameters that you need to evaluate before you decide you should pick fund X over fund Y? So all of those details we'll discuss in the next episode. Until then, thanks so much for watching.